We stay in Latin America, where Peru may be one of the world's most dynamic economies, but it's also running into some trouble. The government now is trying to keep that currency from strengthening too fast, which would derail growth. But Peru is not alone. Dan Collyns has more.
By Peruvian government calculations, it'll take a purchase of at least $4 billion in 2013 to hold down the value of the national currency called the sol. It's a monetary policy designed to keep Peru's economy expanding. While it remains the fastest growing economy in South America, the country's central bankers are concerned that inflation could stall growth. The sol climbed to a 16-year high in January, prompting the finance minister, Miguel Castilla, to intervene more aggressively in the currency markets.
The idea is to be able to intervene at the right moments in coordination with the central bank. This will help avoid a fall in the exchange rate, which could have undesired effects on the export sector.
A stronger sol makes Peruvian exports more expensive. And the export-driven economy here is already feeling the squeeze. Other sectors such as agro-exports and manufacturing were becoming less competitive due to the stronger sol.
Because there is clearly a risk that if the resource sector keeps booming in the way it has boomed, and the sol continues appreciating against other currencies, that the other sectors of the Peruvian economy that are dynamic, which are all primarily export-oriented sectors, apart from real estate in Lima, which is linked to the income linked to extraction, won't be able to sustain their dynamism.
Growth of more than 6% and low inflation are signs of a healthy economy. But with almost half of Peruvian credit in US dollars, the government wants a cushion for any further drop in value. Dan Collyns, CCTV, Lima.
More analysis on what's really going on in the foreign exchange markets in Latin America. Francisco Durand, professor from the University of Texas, joins us. Professor, thank you very much and welcome to Biz Asia America. Let's start by helping our viewers understand. A lot of people say there's a currency war. First of all, what does that even mean?
Well, basically, the Peruvian economy, even if it's growing very fast at a rate of 6%, and this year is going to be growing at that rate as well, it's being hurt by what's happening with the dollar in relation to the Peruvian sol, which is getting devalued. It's a very serious problem. I think one of the factors behind it is that the dollar in the international market is getting devalued, and that's related to the fiscal problems in the U.S. So many people in Latin America, many experts believe that the U.S. is socializing its losses, through the devaluation. But in the case of Peru, there's also an additional factor that makes the situation even more serious. It is the fact that there are many dollars coming to the Peruvian economy because of the drug trade and the illicit trade. And so there is an oversupply of dollars. So the government is very worried about this issue.
Yeah, Professor, maybe you can help elaborate a bit more. As a layman who's watching these currencies, let's just take Brazil, for example. Its economy has been weakening recently, but the currency itself seems to be holding its ground relatively well. And it's similar in a lot of other Latin American countries. How does a weaker or stronger economy affect the currency itself, or is it the other way around?
Well, I would say that in general, the economies of Latin America and Peru in particular are growing very fast. But now the growth is beginning to slow down a little bit. And it is threatened now because most of the growth is based on the export sector. That is the locomotive that has been pulling the Peruvian economy. And that economy works on the basis of dollars mostly. So if the devaluation of the dollar occurs because of international trends, which a situation that Peru doesn't control, and also because of the growth of the illicit trade, especially drug trafficking, there's a point where that is going to be creating an issue and will be slowing growth. So that's basically the...
At the G20 summit in Moscow, Japan was criticized for lack of a better word, manipulating their currency, making sure that it was devalued sufficiently. And I just wanted to ask you, don't most countries generally, and I'm generalizing here, generally want a weaker currency because it helps their exports? Am I on the right track on this?
Well, it depends on what is it that they sell. In the case of Peru and most of Latin America, what we are selling is mostly commodities, raw materials, and that depends basically on prices that are decided in the international market. So we are basically price takers. So if we sell copper and we're paid in dollars that get devalued, the country loses, and that's basically the essence of the problem.
Are there any specific currencies that you see that are more stable than others in Latin America at this time for the next 2 or 3 quarters?
It's becoming a very uncertain scenario. There is nowhere to go. So what governments are doing basically are trying to use their international reserves to buy dollars in the market, as the Peruvian Central Bank is doing, to at least keep it at this level. Just to give you an idea, about 3 years ago, I used to get 3.5 soles for $1. Now I get 2.5. If you're an exporter, you're being hurt. And it's reaching a point where it is affecting future growth, and it is generating worries in the government.
Professor, it sounds like it comes down to profitability on a very big part of it. I want to thank you for your analysis on this, Professor, again, joining us from the University of Texas. Great to have you on the show.